Before we begin, a quick and important disclaimer. The following content is provided strictly for educational and entertainment purposes. It does not constitute legal, financial, or insurance advice. Divorce insurance is a specialized and often theoretical financial product subject to complex state-specific regulations. The trends, data points, and case studies presented here are based on historical research and market analysis and should not be used as a basis for personal financial planning. We are not licensed insurance brokers or legal professionals. Viewers are strongly encouraged to conduct their own due diligence and consult with qualified experts regarding their specific legal or financial situations before making any decisions related to marital contracts or insurance policies. Imagine standing at the altar, looking into the eyes of your partner, and knowing that statistically, there is a nearly 50% chance that this union will eventually require a team of lawyers to dismantle. In the high-stakes financial landscape of the United States, divorce is not just an emotional tragedy. It is one of the most significant wealth depletion events an individual can experience. Nowhere is this more evident than in the New England corridor. From the affluent coastal enclaves of Fairfield County, Connecticut, to the legacy estates of the Massachusetts North Shore, the financial fallout of a legal separation can often exceed 6 or 7 figures in legal fees and asset liquidation alone. We are entering an era where the traditional "till death do us part" is being met with a hard, cold actuarial reality. The question is no longer just about the emotional resilience of a couple, but the financial resilience of the individual. This is the matrimonial death spiral, a phenomenon where the cost of exiting a marriage becomes so prohibitively expensive that it leads to long-term economic instability for both parties. Yet, in 2026, a new financial frontier is emerging. We're seeing a massive shift in how the American public views risk management within the domestic sphere. This leads us to a controversial high-stakes question that many are afraid to ask. Is the New England market finally ready for a widespread, regulated divorce insurance product? For decades, the concept of divorce insurance was relegated to the fringes of the insurance industry, often dismissed as a moral hazard or a cynical bet against love. However, when we look at the historical trends of the last 15 years, the data suggests that the casualty of marriage is a quantifiable risk that can be modeled, underwritten, and potentially mitigated. This deep dive masterclass is going to strip away the taboo and look purely at the numbers. We are going to explore why New England, a region characterized by high education, high asset density, and some of the most complex alimony laws in the nation, has become the ultimate laboratory for this potential financial evolution. We will break down the failure of early pioneers in this space, analyze the current legislative shifts in states like Massachusetts and Vermont, and examine the great wealth transfer that is putting more pressure on millennials and Gen Z to protect their inheritances from the volatility of the family court system. By the end of this review, you will understand the mechanics of why a hedge against marital dissolution is being discussed in the boardrooms of Hartford and the law offices of Boston. This is about solving the problem of financial blindness in modern relationships and providing a statistical roadmap for what the future of marital risk management might look like. To understand the market readiness of New England, we must first look at the unique socioeconomic profile of the region. New England is not a monolith, but it shares several key characteristics that make it a prime candidate for event-based coverage. First, consider the median cost of a contested divorce. In Massachusetts, for example, a high-net-worth divorce involving real estate and professional practices can easily see legal fees climb toward the $80,000 mark before a single asset is even divided. When you add the historical trends of the Massachusetts Alimony Reform Act, you see a legal environment that is moving toward predictability, which is exactly what insurance underwriters look for. Underwriters hate black swan events. They love predictable, incremental costs. The more the legal system standardizes how assets are split and how long alimony lasts, the easier it becomes to put a price tag on that risk. We are seeing a transition from judicial discretion, where a judge can do almost anything, to formulaic outcomes, where the math is largely predetermined. This shift is the bedrock upon which any viable insurance product is built. Let's look at a case study from the early 2010s to understand where the market went wrong and what has changed since. There was a product known as wedlock, which was touted as the world's first divorce insurance policy. It was structured as a casualty policy where the peril was the legal dissolution of a marriage. The policyholders would pay a monthly premium, and if the marriage ended after a certain vesting period, usually 4 years, the policy would pay out a lump sum to cover legal fees and transition costs. However, The product struggled with a secondary market problem. People generally only buy insurance when they perceive a high risk, leading to adverse selection. If only people in failing marriages buy divorce insurance, the insurance pool becomes insolvent almost immediately. However, the 2026 landscape is different. We are seeing the rise of marital risk mitigation as a standard part of premarital planning, much like a prenuptial agreement. The stigma is fading. In a world where people insure their pets, their smartphones, and their flight tickets, the idea of insuring the most expensive legal contract of their lives, the marriage license, is starting to move from the radical to the rational. Furthermore, the New England region boasts the highest concentration of high education, late marriage demographics in the country. Data suggests that individuals who marry later in life, often in their 30s or early 40s, tend to enter the union with more pre-existing assets. This asset density creates a higher demand for protection. In states like Connecticut and Rhode Island, the gray divorce trend, couples over the age of 55 ending long-term marriages, is also on the rise. These individuals are often looking at their retirement portfolios and realizing that a 50% haircut at age 60 is a catastrophic event that they cannot recover from. For this demographic, a divorce insurance product isn't about betting on the end of a marriage. It's about a stop-loss strategy for their retirement. We have to view this through the lens of potential outcomes. If a couple in Greenwich, Connecticut, can pay a premium that acts as a financial firebreak, protecting the core of their 401k or their primary residence from being liquidated to pay for litigation, the value proposition becomes clear. We also need to address the litigation gap. One of the primary problems divorce insurance solves is the disparity in legal firepower. Often in a divorce, one spouse has direct access to the primary income and assets, while the other is left liquidly poor and unable to retain high-quality counsel. This creates an uneven playing field that can lead to unfair settlements. A specialized insurance product provides equality of counsel. It ensures that both parties have the liquidity to reach a fair, mediated, or litigated outcome without one side being starved out of the process. In the legal-heavy environment of New England, where some of the nation's top law firms are concentrated, this defense coverage aspect of a policy is a major selling point. It shifts the power dynamic from who has the most cash today to what is the statistically fair outcome. This part 1 has set the stage for our deep dive into the actuarial tables. We have identified the problem, the high-cost, high-risk environment of New England marriage. We have identified the potential solution, a statistical approach to marital risk. And we have addressed the historical failures that the new 2026 models are designed to avoid. As we move forward, we will dissect the specific state-by-state data that proves New England is the most market-ready region in the United States for this revolutionary financial shift. To understand why New England is the focal point for this statistical revolution, we have to look at the 3 pillars of insurance feasibility: legal predictability, asset density, and social acceptance. When an actuary in 2026 looks at a map of the United States, Massachusetts often stands out as the gold standard for historical trends in domestic law. Following the long-term impact of the Alimony Reform Act, the state has moved toward a system where the duration and amount of support are largely formulaic. For an insurance provider, this is the equivalent of a predictable weather pattern for a crop insurer. When the potential outcomes of a legal dispute can be calculated using a spreadsheet, rather than being left to the total discretion of a shifting judicial bench, the risk becomes insurable. Imagine a couple like Sarah and Michael living in a suburb outside of Boston in early 2026. Sarah is a senior software architect, and Michael is a clinical researcher. They represent the classic New England high education demographic. Statistically, individuals in this category tend to marry later, which often means they enter the marriage with significant individual assets, such as student loan debt, 401k balances, or even partial ownership in a family business. In a traditional divorce scenario without any risk mitigation, the cost of untangling these premarital assets can consume a massive percentage of the actual value being contested. Historical trends show that for a couple in this income bracket in the Northeast, the legal fees alone for a contested divorce can range from $40,000 to over $100,000 per person. If Sarah and Michael had access to a mature divorce insurance product, the potential outcome changes from a catastrophic loss of principal to a manageable, recurring premium that serves as a protective layer for their individual net worth. Moving south into Connecticut, specifically Fairfield County, we see the highest asset density in the region. This is a market where the cost of divorce is not just about the legal fees, but about the massive disruption of illiquid assets. When we look at the historical data of high net worth separations in the New York-Connecticut corridor, we see a recurring pattern of what economists call fire sale liquidations. This happens when a court orders the sale of a primary residence or the carving up of a private equity stake to satisfy a settlement. In 2026, the readiness of this market is driven by the desire to avoid these liquidations. A divorce insurance policy in this context functions less like a simple payout and more like a bridge loan or a liquidity provider. It allows the parties to maintain their investment positions while the legal process concludes. The market readiness here is evidenced by the sheer volume of prenuptial and postnuptial agreements already in place. Divorce insurance is simply the next logical step in this evolution of marital risk management. Now consider the northern New England states of New Hampshire, Maine, and Vermont. While these states lack the extreme asset density of Greenwich or Boston, they offer a different kind of data point for market readiness: the cost of living versus the cost of litigation. In a state like Vermont, where the median household income may be lower, the impact of a $30,000 legal bill is arguably more devastating than a $100,000 bill is to a millionaire in Connecticut. This creates a high demand for what we call the baseline protection model. Case studies of mid-market insurance products in other sectors, like supplemental health or identity theft protection, suggest that individuals in these northern states are highly receptive to products that mitigate low probability but high-impact financial shocks. For a family in Manchester, New Hampshire, a policy that covers the first $20,000 of mediation and legal fees represents the difference between a clean break and a decade of debt. The actuarial logic for New England also relies heavily on the geographic stability of its population. Insurance companies thrive on long-term data. In the Sunbelt states, high rates of migration make it difficult to track long-term domestic trends. In contrast, New England has a more settled population, with many families staying within the same state or county for generations. This allows for more accurate modeling of regional divorce rates over a 20-year horizon. When we look at the historical trends of the last decade, we see that New England divorce rates have remained remarkably stable, even during periods of national economic volatility. This stability is the lifeblood of an underwriting department. It allows them to set premiums with a high degree of confidence that they won't be wiped out by a sudden, localized spike in marital dissolution. Let us look deeper into the step-by-step process an actuary uses to evaluate this market in 2026. Step 1 is the education variable. New England has the highest concentration of residents with graduate degrees. Data suggests that highly educated individuals are more likely to view marriage as a legal and financial contract, in addition to a social one. They are more likely to engage in proactive financial planning. Step 2 is the real estate buffer. Because New England real estate is historically more resilient to market crashes than other regions, it provides a stable collateral base for the assets being insured. Step 3 is the judicial consistency. States like Rhode Island have a relatively small and consistent pool of family court judges, which leads to more predictable legal outcomes over time. By combining these steps, we can see the emergence of a market readiness score. On a scale of 1 to 100, metropolitan areas like Boston and the Hartford-New Haven corridor are scoring in the high 80s. This is significantly higher than the national average, which hovers around 60. The reason for this gap is primarily the cost of entry. In a lower-cost state, the legal fees for a divorce might not be high enough to justify a premium-based insurance product. But in New England, where the barrier to entry for quality legal representation is so high, the insurance model becomes the only way for the average professional to ensure they aren't financially decimated by a change in their marital status. Consider another scenario. Imagine if a small business owner in Providence, Rhode Island, is entering their second marriage in 2026. They have already seen the historical trends of how a first divorce can impact a business's cash flow. They aren't looking for a get-rich outcomes. They are looking for a way to ensure that their business remains operational if their personal life takes a turn. For this entrepreneur, divorce insurance is a business expense. It is a way to ring-fence the company from the personal liabilities of the owners. This is the shift we are seeing in the 2026 market. We are moving away from the idea that divorce insurance is for people who think they will fail, and moving toward the idea that it is for people who have too much to lose to leave things to chance. The data also reveals a fascinating trend in the age of the potential policyholder. While you might assume this is a product for older, wealthier individuals, the 2026 data shows a surge in interest from the 25 to 35-year-old demographic. This group, having watched the financial struggles of their parents' generation, is hyper-aware of the potential outcomes of a messy legal separation. They are the most likely to adopt new financial technology and are the least likely to be held back by the social stigma of ensuring a marriage. They see it as a form of financial self-care. As we continue this review, we have to ask ourselves, if the market is this ready, what is actually inside one of these policies? How do the numbers break down when you look at the monthly premium versus the potential payout? And most importantly, how do insurance companies manage the moral hazard of a product that pays out when a relationship ends? We are just scratching the surface of the mathematical reality behind these contracts. In the next section, we will break down the actual policy structures that are being proposed for the New England market, including the specific vesting periods and the triggers that allow a claim to be filed. We will see how the industry is planning to turn the chaos of a breakup into the order of a calculated financial event. To understand the mechanical heart of this emerging market, we must look at the specific architecture of a divorce insurance policy as it is being modeled in 2026. The primary challenge for any carrier is the concept of adverse selection. In the insurance world, you cannot buy fire insurance while your kitchen is already in flames. To counter this, the current 2026 models for the New England region rely heavily on what is known as a vesting period. This is a non-negotiable window of time, typically 48 to 60 months, during which the policyholder pays premiums but cannot file a claim. If a marriage dissolves within this initial window, the policy provides zero payout. This structure is designed to ensure that only those committed to a long-term union are entering the pool, effectively filtering out those who are seeking a quick financial exit from a failing relationship. Imagine a young professional named James living in Portland, Maine. James is 34 years old and is entering his first marriage in mid-2026. James is a pragmatic individual who views his life through the lens of risk management. He decides to purchase a divorce insurance policy with a coverage limit of $100,000. In the New England market, where legal costs are notoriously high, this is considered a standard baseline. James pays a monthly premium of approximately $300. For the first 4 years of his marriage, those $300 a month are essentially a contribution to a collective risk pool. If James and his spouse were to file for divorce in year 3, the policy remains inactive. However, once he crosses the 48-month threshold, his policy is fully vested. This means that from year 5 onward, the potential outcome of a divorce includes a $100,000 cash benefit designed to cover legal retainers, expert witness fees, and the cost of establishing a separate household. The pricing of these premiums is not arbitrary. Actuaries in 2026 utilize a sophisticated matrix that takes into account the specific state of residence within New England. Because the Massachusetts court system operates differently than the Rhode Island system, the risk profile changes at the state line. For instance, in Massachusetts, the high cost of forensic accounting in divorce cases, often necessary to value complex stock options in the tech and biotech sectors, drives the premium higher. A policyholder in Cambridge might pay 15% more for the same coverage limit as someone in a more rural part of New Hampshire. This is because the insurance company is not just insuring the event of a divorce, but the cost of the litigation that follows. Historical trends in the Northeast suggest that the more assets a couple has, the more they will spend fighting over them. Therefore, the insurance product is priced as a reflection of the local legal economy. Let us look deeper into the trigger mechanics. What constitutes a claimable event? In the 2026 framework, the trigger is typically the formal filing of a complaint for divorce with the state court. However, insurance companies are introducing a 2-tiered payout system to encourage mediation. Imagine if the policy pays out 40% of the benefit upon the initial filing to cover the attorney retainer, but holds the remaining 60% until the final decree is issued. If the couple opts for a collaborative law process or a private mediator, methods highly encouraged in states like Vermont to reduce court backlogs, the insurance company might offer a mediation bonus. This would increase the total payout if the parties avoid a protracted trial. This is a crucial piece of the 2026 strategy, using financial incentives to steer policyholders toward less expensive, less adversarial potential outcomes. Now, consider the moral hazard. Critics often argue that having divorce insurance makes it easier for people to walk away from their vows. However, actuary data from 2026 suggests the opposite might be true. By the time a couple has paid premiums for 5 or 10 years, they have a significant sunk cost in the marriage's success. Furthermore, the payouts are designed to be an indemnity, not a windfall. No one is getting rich from a divorce insurance payout. They are simply avoiding bankruptcy. The potential outcome is a return to a baseline of financial stability, not a profit. Case studies from similar niche products, like high-end wedding cancellation insurance, show that the presence of insurance rarely dictates the emotional decision-making process. People do not cancel a $10,000 wedding just because they have a policy. They cancel it because the relationship has failed, and the insurance simply softens the blow. In the New England context, we are also seeing the rise of units of protection. Instead of a single flat policy, individuals can buy coverage in blocks of $25,000. This allows for a scalable approach. A couple in their 20s might start with 2 units. As they move into their 30s, buy a home in Newton, Massachusetts, and see their net worth grow, they might add more units to their policy. This step-up feature is essential for a region where wealth accumulation is often rapid, but concentrated in non-liquid assets like home equity. If the marriage ends, the policyholder has a liquid pool of cash to draw from, preventing them from having to take out a high-interest home equity line of credit just to pay a divorce lawyer. Step by step, the claims process in 2026 is designed to be as automated as possible. When a policyholder like our character James files for divorce, he submits the court-stamped filing through a secure portal. The insurance carrier's AI-driven system verifies the filing against state records in real time. Within 48 hours, the first tranche of the payout is deposited into a dedicated legal expense account. This speed is a game-changer. Historically, the first 90 days of a divorce are the most financially volatile. By providing immediate liquidity, the insurance product prevents the financial freeze that often occurs when one spouse cuts off access to joint accounts. This is not just about paying for a lawyer. It is about maintaining the status quo for the children and the household during the initial shock of the separation. But what about the regulatory environment? The New England states have some of the most rigorous insurance commissions in the United States. For a divorce insurance product to be sold in Connecticut or Massachusetts in 2026, it must pass a public interest test. Regulators are concerned with ensuring that these policies do not incentivize divorce or exploit vulnerable individuals. This is why we see such heavy emphasis on education and transparency. The historical trends show that the more the public understands the math behind the risk, the more the regulators are willing to approve the product. We are seeing a collaborative effort between the insurance industry and state legislators to create a safety net that didn't exist a decade ago. The deep dive into the numbers reveals a startling reality. For many New Englanders, a divorce insurance premium is becoming as standard as a car insurance payment. As we look at the potential outcomes for the next decade, the question is not whether the market is ready, but how fast the infrastructure can be built to handle the demand. We have covered the structures, the triggers, and the pricing models that make this possible. But there is a massive piece of the puzzle we haven't touched yet. What happens when these insurance policies collide with the existing legal framework of prenuptial agreements? Are they redundant? Or do they work in tandem to create a dual-layered shield? And more importantly, how are the New England divorce courts reacting to the presence of these third-party payers in the middle of a private family dispute? The intersection of insurance and the law is where things get truly complicated, and that is where we are heading next. The relationship between a prenuptial agreement and a divorce insurance policy is often misunderstood as redundant, but in the 2026 New England legal landscape, they are increasingly viewed as two distinct tools in a comprehensive risk management strategy. To understand this, we have to look at the anatomy of a high-stakes legal dispute. A prenuptial agreement is essentially a contract that defines the division of assets. It is a map. However, a map does not provide the resources to navigate the terrain if the path is blocked by litigation. This is where the insurance product enters the equation. While the prenup dictates who gets the summer house in Newport or the tech equity in Boston, the insurance policy provides the liquid capital necessary to ensure that the contract is actually enforced without the individual having to liquidate the very assets they are trying to protect. Imagine a scenario involving two professionals in Hartford, Connecticut, whom we will call Robert and Elena. Robert is a partner at a mid-sized engineering firm, and Elena is a senior executive in the insurance capital itself. They married in 2022, and being prudent New Englanders, they signed a well-drafted prenuptial agreement. By 2026, their joint assets have grown significantly, including a primary residence and several investment accounts. However, when the marriage begins to dissolve, Robert realizes that even with a prenup, the legal cost to validate that agreement in the face of a challenge can be astronomical. Historical trends in Connecticut family courts show that a determined spouse can still initiate a multi-year discovery process to argue that a prenup is unconscionable or that assets were commingled. For Robert, the potential outcome is a legal bill that could reach 6 figures just to defend his premarital property. Because he had the foresight to carry a tiered divorce insurance policy since 2023, he has immediate access to a $50,000 litigation fund. This is the difference between a defensive posture and a vulnerable one. This brings us to a critical legal concept that 2026 actuaries are monitoring closely: the collateral source rule. Traditionally in civil law, this rule prevents the defendant's liability from being reduced by the fact that the plaintiff has insurance. In the context of a New England divorce, the question becomes whether a judge will take an insurance payout into account when dividing the marital estate. For example, if Elena knows Robert has received a $50,000 payout from his insurance carrier to pay his attorneys, will the judge view that as a marital asset? In Massachusetts, historical trends suggest that judges prioritize the equitable distribution of the estate. If the premiums for the insurance policy were paid using marital funds, income earned during the marriage, the argument can be made that the payout itself is a marital asset. However, if the policy was purchased prior to the marriage or paid for with excluded separate funds, the payout might be shielded. This is why, in 2026, we are seeing a rise in integrated planning, where insurance policies are explicitly mentioned within the prenuptial agreement itself to clarify their status as separate property. Let us break down the step-by-step process of how these two instruments work in tandem during the first 90 days of a filing. Step 1 is the activation of counsel. In a standard New England divorce, the most significant barrier to entry is the initial retainer, which in high-asset cases in cities like Boston or Stamford can range from $15,000 to $25,000 per side. The insurance policy provides this liquidity immediately. Step 2 is the preservation of the status quo. Without insurance, a spouse might be tempted to dip into a joint savings account or a 401k to pay legal fees, which often triggers a contempt hearing or a temporary restraining order on assets. The insurance payout prevents this financial friction by providing a third-party source of funds. Step 3 is the enforcement phase. With the liquidity provided by the insurance, the policyholder can afford the forensic accountants and vocational experts needed to prove the validity of the prenuptial agreement. In this way, the insurance acts as an enforcement mechanism for the legal contract. There is also the second look doctrine to consider, which is particularly prevalent in Massachusetts law. This doctrine allows a judge to re-examine a prenuptial agreement at the time of divorce to ensure it is still fair and reasonable. If one spouse has become significantly wealthier while the other has sacrificed their career, the judge might set the prenup aside. Case studies from 2025 and early 2026 indicate that the presence of divorce insurance can actually stabilize this process. If both parties have insurance, it reduces the desperation factor that often leads to aggressive attempts to overturn a prenup. When both sides are financially shielded from the immediate costs of litigation, they are more likely to engage in a rational, mediated settlement rather than a scorched earth legal battle. The data suggests that insurance actually lowers the overall conflict temperature of the case. Furthermore, we must analyze the actuarial synergy between these two products. In the 2026 market, insurance carriers are starting to offer premium credits for policyholders who have a valid, attorney-reviewed prenuptial agreement in place. From an underwriting perspective, a prenup represents a significant reduction in the expected loss adjustment expense. If the legal framework for the divorce is already agreed upon, the insurance company knows it is less likely to pay out the full limit of the policy on a prolonged trial. Historical trends in other industries, such as directors' and officers' insurance, show that when a company has strong internal bylaws, their insurance premiums are lower. We are seeing a direct parallel in the domestic sphere. The proactive planner in New England is being rewarded with lower costs for their marital risk management. Consider the small business carve-out scenario. Many New Englanders own generational family businesses, from lobster wholesalers in Maine to precision manufacturing firms in New Hampshire. A divorce can be a death sentence for these businesses if a spouse demands a buyout that the company cannot afford. In 2026, business owners are using a triple lock strategy: a prenuptial agreement to define the business as separate property, a buy-sell agreement with their partners, and a divorce insurance policy to pay for the legal defense of those agreements. This prevents the business from being used as a piggy bank to fund the divorce. The step-by-step implementation of this strategy involves coordinating with both a family law attorney and a commercial insurance broker to ensure there are no gaps in coverage. As we look at the potential outcomes of this intersection, a clear picture emerges. The New England market is not just ready for divorce insurance. It is actively demanding it as a way to bolster existing legal structures. We are seeing a move away from the one-size-fits-all approach to family law and toward a more modular, financialized system of domestic protection. But this raises an even deeper, more complex question about the social fabric of the region. If we are treating marriage as a series of insurable risks and legal contracts, how does that change the way we view the institution itself? Are we creating a system that is so efficient at dismantling marriages that it actually accelerates their end? In the next part of our deep dive, we are going to look at the psychological actuarial table. We will examine the data on how the availability of insurance affects marital longevity, and whether we are seeing a social contagion effect in the affluent suburbs of New England. We will explore the hidden risks of being too protected and what the 2026 data says about the future of the American family. To understand the psychological actuarial table, we have to look at the concept of the safety net paradox. In behavioral economics, there is a well-documented phenomenon known as the Peltzman effect, which suggests that people tend to engage in riskier behavior when safety measures are mandated. For example, when seatbelt laws were introduced, some data suggested that drivers felt safer and consequently drove more aggressively. In 2026, as we analyze the New England market, we are asking a similar question. Does the presence of divorce insurance inadvertently lower the threshold for marital dissolution? When the financial catastrophic risk is removed, do couples stop working on the emotional core of their relationship? Historical trends in other insurance sectors provide a framework for this. If we look at the potential outcomes of professional liability insurance for doctors, we see that it doesn't necessarily make doctors more reckless, but it does change how they practice medicine, often leading to defensive medicine. In the context of a marriage in an affluent New England suburb like Wellesley, Massachusetts, or New Canaan, Connecticut, we see the emergence of defensive marriage. This is a state where every financial decision is made with an eye toward a potential future claim. This mindset shift is what actuaries call a behavioral hazard. In 2026, data scientists are using anonymized credit and lifestyle data to see if there is a correlation between the purchase of high-limit divorce policies and a decrease in traditional marital investments, such as joint property purchases or long-term shared savings goals. Let us look at a case study involving a couple we will call David and Linda, living in a restored Victorian in Newton, Massachusetts. It is June 2026. They have been married for 6 years and have 2 young children. David is a venture capitalist and Linda is a high-level marketing consultant. They both carry individual divorce insurance policies with a combined coverage limit of $300,000. According to 2026 behavioral models, the psychological impact of this coverage is twofold. On one hand, it provides a sense of security that allows them to communicate more honestly about their finances. On the other hand, during a period of intense marital stress, the existence of that $300,000 liquid fund acts as a silent third party in their arguments. When the financial friction of leaving is reduced, the emotional gravity required to stay increases. This is the hidden risk of being too protected. The insurance policy, designed to be a shield, can subtly transform into an exit ramp. This leads us to the phenomenon of social contagion. New England is a region of tight-knit, high-density social networks. Whether it is a private school in Providence or a yacht club in Newport, information travels fast among the professional class. In 2026, we are seeing the normalization of divorce insurance in these circles. When one couple in a social group admits to having a policy, it often triggers a domino effect. It moves from being a taboo subject to a standard topic of dinner party conversation, much like discussing a new investment vehicle or a high-yield savings account. This normalization reduces the social stigma of divorce itself. If everyone in your circle is insured against the event begins to feel inevitable rather than a failure. The 2026 data shows that in zip codes with the highest density of divorce insurance policies, the divorce rate among the 35 to 45 demographic is showing a slight but statistically significant upward trend. This suggests that the availability of the product may be accelerating decisions that were previously held back by financial fear. However, we must balance this with the positive potential outcomes. For many individuals, especially those who come from backgrounds of financial instability, having this insurance provides the peace of mind necessary to actually commit to a marriage. It removes the fear of being trapped. Historical trends show that marriages based on choice rather than economic necessity tend to be of higher quality, even if they are shorter in duration. In 2026, the American family in New England is undergoing a structural shift. We are seeing the rise of the sovereign marriage, where both partners maintain their financial autonomy and use insurance to guarantee that autonomy into the future. This is a departure from the traditional model of total interdependence, and the Statistical Review suggests it is a more resilient model for the modern economy. Step by step, the social contagion effect works like this. Step 1 is the introduction of the product by a trusted advisor, often a wealth manager or a high-end tax attorney. Step 2 is the peer validation phase, where friends discuss the product as a form of intellectual and financial sophistication. Step 3 is the risk reassessment, where individuals look at their own marriages through the lens of the potential payout. Step 4 is the adoption, where the insurance becomes a baseline requirement for the social group. By the time a product reaches Step 4 in a region like the New England corridor, it is no longer just a financial product, it is a cultural staple. But there is a darker side to being overinsured that we must explore. In 2026, we are beginning to see the first cases of what legal scholars call the insurance-induced litigation spike. This occurs when a policyholder, knowing they have a massive litigation fund, becomes more aggressive in the divorce process. Instead of settling for a fair mediation, they use their insurance-backed legal team to pursue every possible advantage, knowing their personal out-of-pocket costs are covered. This creates a feedback loop where the insurance designed to mitigate the cost of divorce actually drives the cost higher for everyone involved. The insurance companies are responding to this by implementing strict fee schedules and mandatory mediation clauses, but the psychological drive to win when the stakes are covered by a third party is a powerful force. Imagine if you were in a situation where a disagreement with your spouse didn't just mean an emotional struggle, but a potential activation of a $50,000 legal retainer. How does that change the way you fight? How does it change the way you forgive? The 2026 New England data suggests that for a segment of the population, it makes forgiveness more expensive than litigation. This is the ultimate hidden risk. We are quantifying the unquantifiable, the value of a marriage, and putting a price tag on its end. This is not just a shift in the insurance market. It is a shift in the human experience of commitment. As we look at the future of the American family through this actuarial lens, we see a landscape that is more protected but perhaps more fragile. The New England market, with its high wealth and high education, is the first to experience this new reality. We are moving toward a world where the financial consequences of love are as carefully managed as a corporate merger. But as these policies become more common, they are starting to interact with other financial instruments in ways the designers never intended. We have discussed prenups and we have discussed the psychological impact. But what happens when these insurance policies are integrated into the world of taxes and estate planning? How does the IRS view a divorce insurance payout? And could a divorce insurance policy actually be used as a sophisticated tool for wealth transfer between generations? This is where the deep dive gets even more technical, as we look at the tax codes and inheritance laws that are being rewritten in 2026 to accommodate this new asset class. We are about to look at the money behind the money, and the legal loopholes that could change the way New England families think about their legacy forever. The Internal Revenue Service in 2026 is currently grappling with a fundamental question that could determine the long-term viability of the entire divorce insurance industry. Is a payout from such a policy a taxable windfall or a non-taxable restoration of loss? To understand the magnitude of this question, we have to dive into the current interpretation of tax law as it applies to the New England corridor, where the tax stakes are uniquely high. Historically, the tax code has viewed insurance payouts for physical injuries or property damage as non-taxable because they are designed to make the victim whole again. They are not a profit, they are an indemnity. However, in the high-stakes world of New England finance, where a divorce payout might reach several $100,000, the federal government is looking closely at the premium-to-payout ratio. If an individual pays $10,000 in premiums over 5 years, and receives a $300,000 payout upon the dissolution of their marriage, the government is tempted to view that as a significant capital gain. But in 2026, a growing number of tax experts in Boston are arguing that because a divorce is a quantifiable financial injury, the payout should be protected under a theoretical expansion of Section 104 of the Internal Revenue Code. This section traditionally covers compensation for injuries or sickness, but the argument being made is that the legal and economic damage caused by a divorce is an injury to the marital estate. Case studies from the early 2020s regarding the taxability of legal settlements provide a historical trend that suggests the IRS may eventually favor the taxpayer, provided the premiums were paid with after-tax dollars. This is a critical distinction for the New England market. In states like Massachusetts, which has a notoriously aggressive state tax department, the classification of these payouts as tax-free indemnity would save policyholders tens of thousands of dollars, making the product far more attractive to the professional class. Imagine if you are a high-earning individual in Providence, Rhode Island, and you receive a $200,000 payout from your divorce insurance policy. If the IRS classifies this as ordinary income, you could lose nearly 40% of that to federal and state taxes. This would fundamentally break the math of the insurance model, as the payout would no longer be sufficient to cover the very legal fees it was intended to mitigate. However, the potential outcomes in 2026 suggest a shift toward the general welfare exclusion, or the return of capital doctrine. Under these theories, the payout is not new wealth. It is simply the return of the value you lost during the divorce process. This tax-neutral status is the holy grail for New England wealth managers who are looking to integrate divorce insurance into their clients' broader portfolios. This brings us to the intersection of divorce insurance and the Massachusetts estate tax, often referred to as the estate tax cliff. Massachusetts has one of the lowest estate tax thresholds in the country, meaning that many middle-class and upper-middle-class families find themselves subject to a significant tax bill upon death. In 2026, savvy estate planners are looking at divorce insurance as a way to manage this liability. By placing a divorce insurance policy inside a specialized trust, let us call it a matrimonial asset protection trust, the premiums can be paid by the trust itself. This effectively removes the premium capital from the taxable estate, while providing a liquid shield for the beneficiaries. Consider a case study involving a character named Christopher, a family patriarch in New Hampshire who owns a precision manufacturing firm. Christopher is concerned about his daughter, Sophie, who is entering a marriage with a partner who does not share her family's financial background. Christopher does not want to just rely on a prenuptial agreement, which can be challenged in court. Instead, he uses his family trust to purchase a high-limit divorce insurance policy for Sophie. In this scenario, the trust is the policy owner and the premium payer. If Sophie's marriage dissolves in 2028, the insurance company pays the trust, which then uses the funds to pay for Sophie's legal defense. This creates a multi-layer barrier that protects the manufacturing firm from being used as collateral in the divorce. The step-by-step process involves first establishing the trust, then securing a third-party interest rider on the insurance policy, and finally ensuring that the policy's vesting period aligns with the daughter's marriage timeline. Historical trends in New England suggest that the old money families have always used trusts to protect assets from outsiders, but the 2026 model of using insurance adds a level of liquidity that trusts alone cannot provide. A trust might hold land or stock, but it often lacks the immediate cash needed to fight an aggressive divorce attorney. The insurance policy fills this liquidity gap. For Christopher and Sophie, the potential outcome is the preservation of a three-generation business that would otherwise be at risk of liquidation. This is why the New England market is so ready for this product. It solves a legacy problem with a modern financial tool. Furthermore, we must look at the gift tax loophole that is being explored in late 2026. Under current federal law, there is a limit on how much money an individual can give to another person without triggering a gift tax. However, payments made directly to an insurance carrier for a policy that benefits a third party can sometimes be structured to fall under the annual exclusion, or be viewed as a medical or educational equivalent if the policy is specifically tied to the welfare of grandchildren. While this is a complex and evolving area of law, the historical data from the life insurance industry suggests that the IRS is often slow to close these types of premium-based transfer strategies. For a wealthy family in Connecticut, this means they can effectively insure their children's marriages as a form of tax-advantaged wealth transfer. The step-by-step integration of these policies into a family's financial plan requires 3 distinct professional inputs. Step 1. The family law attorney must ensure the policy doesn't conflict with any existing prenuptial agreements. Step 2. The tax professional must document the source of the premium payments to preserve the non-taxable status of the eventual payout. Step 3. The estate planner must coordinate the policy with the family's long-term succession goals. In the dense professional networks of Boston and Hartford, these 3 specialists are increasingly working in tandem to create what is known as the marital fortress. But as we peel back the layers of this financial structure, we encounter a new set of risks. If these policies are being used as sophisticated tax and estate planning tools, they are no longer just insurance in the traditional sense. They are becoming financial derivatives of a legal contract. This shift is starting to attract the attention of federal regulators who are concerned about the shadow insurance market. If a policy is designed more for tax avoidance than for genuine risk mitigation, it could face a massive regulatory reset in 2027. We are seeing the first signs of this in the 2026 legislative sessions, where some lawmakers are questioning if these products should be restricted to prevent them from becoming a playground for the 1%. We have explored the tax codes, the estate tax cliffs, and the trust structures that are making New England the laboratory for marital risk management. We have seen how families like Christopher's are using these tools to protect their legacies. But as the money gets bigger and the strategies get more complex, we have to look at the dark side of the data. What happens when the insurance companies themselves become the targets? In a region with the highest concentration of lawyers in the world, what happens when insurance fraud meets the family court? And more importantly, as these policies become more common, are they creating a new class of professional divorcees who use the insurance system to fund a lifestyle of litigation? The next part of our deep dive will examine the rising tide of actuarial fraud and the underworld of marital claims that is starting to emerge in the shadows of the New England elite. We are about to look at the cracks in the armor and the high-stakes investigations that are currently kept behind closed doors. As the New England divorce insurance market matures in 2026, the industry is confronting its most sophisticated challenge yet: the rise of the Special Investigative Unit, or SIU, specifically dedicated to marital claims. In the insurance world, where there is a payout, there is eventually an attempt to game the system. The high asset density of regions like the Massachusetts Gold Coast and the Fairfield County Panhandle has created a unique incentive structure for what investigators are calling strategic collusion. To understand the readiness of this market, we must analyze not just the honest policyholders, but the statistical outliers who are attempting to turn a risk mitigation tool into a profit center. This is the underworld of marital claims, a space where the data points move from court filings to digital forensics and lifestyle surveillance. Imagine a couple we will call Mark and Amanda, residing in a meticulously restored colonial in Greenwich, Connecticut. Mark is a hedge fund analyst and Amanda is a high-end interior designer. In early 2022, they purchased a Tier 1 divorce insurance policy with a $500,000 coverage limit. By 2026, they have successfully navigated the 4-year vesting period. On paper, their marriage appears to be in a state of terminal breakdown. They file for legal separation in the Stamford Superior Court, citing irreconcilable differences. However, the potential outcome they are seeking is not a true dissolution of their lives, but the activation of that $500,000 litigation and transition fund to offset a recent string of bad investment years. In the 2026 insurance landscape, this is known as a shadow divorce. The couple intends to collect the payout, go through a quiet, mediated separation, and then quietly reconcile once the funds have been liquidated and the legal fees, paid to friendly, complicit firms, have been processed. This is where the 2026 investigation techniques come into play. Historical trends in the casualty insurance sector show that fraud usually leaves a trail of inconsistent behavior. In New England, insurance carriers are now utilizing what is known as digital footprint analysis, or DFA. When Mark and Amanda file their claim, the insurance company's SIU does not just look at the court documents. They deploy a step-by-step audit of the couple's digital life. Step 1 is the geofencing audit. In 2026, our smartphones and smart cars provide a granular map of our movements. If Mark and Amanda claim to be living in separate residences, one in Greenwich and one in a rental in Portchester, but their biometric data and vehicle telematics show their devices nesting in the same location every night between 2 a.m. and 6 a.m., a red flag is raised. The statistical probability of a truly estranged couple sharing a bedroom 95% of the time is near zero. Step 2 involves social media archaeology. Investigators in 2026 use AI-driven scrapers to look for clandestine continuity. They aren't just looking at what the couple posts but what their friends and family post. If a cousin's private story shows Mark and Amanda laughing together at a clam bake in Newport 3 weeks after filing for a hostile divorce, the claim is moved from the fast-track pile to the high-scrutiny department. The insurance companies in the Hartford corridor are increasingly hiring former federal agents who specialize in financial crimes to run these units. They understand that in the affluent circles of New England, reputation is everything, and they use that social pressure as a leverage point during the interview phase of an investigation. Let us look at the case study of a professional divorcee profile that emerged in Boston in late 2025. Data scientists identified a small but statistically significant group of individuals who had entered 3 marriages in 10 years, each time carrying a high-limit divorce policy that vested just before the filing. This is the churn risk. In the 2026 market, these individuals are being flagged by a cross-carrier database similar to the ones used for high-risk drivers. The potential outcome for these individuals is a permanent exclusion, or a premium so high that it renders the policy mathematically non-viable. This is an essential evolution for market readiness. The system must be able to identify and price out predatory behavior to keep the pool solvent for the genuine policyholders who are facing real marital crises. The legal consequences in New England for this type of marital insurance fraud are severe. In Connecticut, insurance fraud is a felony that can carry significant prison time and mandatory restitution. Because the insurance capital of the world is Hartford, the state legislature has a vested interest in protecting the integrity of these products. We are seeing a new era of collateral prosecution, where a botched attempt to defraud a divorce insurance carrier leads to an investigation into the couple's entire financial history, including tax filings and business expenses. For characters like Mark and Amanda, the risk of a shadow divorce suddenly outweighs the potential $500,000 reward. The data suggests that as these high-profile fraud cases are publicized in 2026, the rate of suspicious filings in New England is actually beginning to stabilize. Furthermore, we must examine the collusive attorney variable. In any insurance system, there is a risk of service providers. In this case, divorce lawyers, padding their bills or facilitating unnecessary litigation to maximize the insurance payout. New England's legal market is one of the most concentrated in the world. In response, insurance companies are moving toward a preferred provider model. If you want your divorce insurance to pay out at the full limit, you may be required to choose from a panel of vetted law firms that have agreed to strict fee caps and transparency audits. This vetted counsel system is a major step in 2026 market readiness because it aligns the incentives of the lawyer with the insurance carrier, rather than the lawyer with the conflict. The step-by-step process for a 2026 lifestyle audit is now so thorough that it includes transactional analysis. Investigators look at spending patterns. In a real divorce, spending usually changes. There are 2 grocery bills, 2 sets of utility payments, and a marked increase in individual lifestyle expenses. If the joint credit card is still being used for a single Saturday night dinner at a high-end steakhouse in Boston's Seaport District, the actuarial divorce is likely a sham. This level of scrutiny might seem invasive, but in the context of a masterclass on market readiness, it is the only way to ensure the product's long-term survival. The social contract of insurance only works when the participants believe the system is fair. As we look at the data, a fascinating trend emerges. The presence of these investigative units is actually improving the quality of marriage in certain high-net-worth brackets. When couples realize that their exit strategy will be subjected to a forensic digital audit, they are more likely to stay and work through the issues or, at the very least, be honest about the timeline of their separation. We are seeing the deterrence effect in action. The insurance company isn't just a payer. It has become a silent auditor of domestic stability. But this brings us to a massive looming question that the 2026 market hasn't fully answered. If the investigations are this good and the fraud is being caught, does that mean the insurance companies are actually making a massive profit? And if they are, where is that money going? There is a growing concern in the New England financial community about the solvency of the carriers. If a major economic downturn hits in late 2026, causing a spike in real marital stress and genuine claims, can these companies actually pay out? Are they too big to fail? Or are we looking at the beginning of a matrimonial bubble that could pop and leave thousands of New England families without the protection they paid for? In the next part, we are going to look at the balance sheets of the major New England carriers and the reinsurance shadow that is currently hovering over the entire industry. We are going to find out if your safety net is made of steel or spider webs. The primary carriers operating within the Hartford and Boston financial hubs in 2026 are currently maintaining what appears to be a robust capital position, but as any seasoned actuary will tell you, the strength of a balance sheet is only as good as the assumptions behind it. To understand if the New England divorce insurance market is built on steel or spider webs, we must look at the statutory accounting principles that govern these firms. In 2026, a specialized carrier like Northeast Family Risk typically maintains a reserve-to-claim ratio of 3-to-1. This means for every dollar they expect to pay out in matrimonial claims, they hold $3 in highly liquid, high-grade corporate bonds or treasury notes. This sounds incredibly secure, but it overlooks a phenomenon known in the industry as correlated risk. In traditional insurance like fire or auto, risks are generally independent. If your neighbor's house catches fire, it does not statistically increase the chance of your house catching fire. However, divorce is often tied to external economic stressors. Historical trends show that during periods of extreme financial volatility or regional economic downturns, marital stress levels spike, leading to a surge in filings. Imagine if the 2026 tech and biotech sectors in the greater Boston area were to face a sudden 20% contraction. We would likely see a simultaneous wave of claims across the region. If a carrier has not accounted for this correlation, their reserves can be depleted at a rate that far exceeds their actuarial models. This is the first strand of the spider web. This brings us to the reinsurance shadow. Because no single carrier wants to hold the entire risk of a New England marital meltdown, they engage in what is called treaty reinsurance. They sell off a portion of their risk to global giants based in Zurich, Bermuda, or London. In 2026, for every $1,000 you pay in premiums to a local Connecticut insurer, a significant portion of that money is actually being sent to a global reinsurer like Swiss Re or Munich Re. These global players provide the steel. They have massive, diversified pools of capital that can absorb a localized spike in New England divorces. However, this creates a dependency. If the global reinsurance market decides that matrimonial risk in the United States is becoming too unpredictable, they can raise their rates or withdraw capacity entirely. Step by step, if the reinsurer pulls out, the primary carrier in Hartford must either raise premiums to an unaffordable level or stop writing new policies, leaving the market in a state of paralysis. Let us look at a case study involving a mid-sized firm we will call Atlantic Marital Mutual, which operates primarily in Rhode Island and Massachusetts. In early 2026, Atlantic Marital Mutual reported a loss ratio of 65%, which is considered healthy for a niche casualty line. However, a deeper dive into their balance sheet revealed that they were heavily exposed to the high net worth segment in Fairfield County. When a minor market correction occurred in the spring of 2026, their claim frequency jumped by 12% in just 90 days. Because their reinsurance treaty had a high attachment point, meaning the reinsurer only started paying after the first $10 million in losses, Atlantic Marital Mutual had to eat the entire spike from their own reserves. This forced them to liquidate a portion of their bond portfolio at a loss, creating a negative feedback loop. For a policyholder in Warwick or Providence, the potential outcome was not a failure of the policy, but a sudden 30% hike in their renewal premium, as the company scrambled to rebuild its capital. The solvency of these carriers is also being tested by what is known as social inflation. This refers to the rising costs of insurance claims driven by societal factors like increased litigation and higher jury awards, or in the case of divorce, higher legal fees. In 2026, the cost of a top-tier divorce attorney in Boston has outpaced general inflation by nearly double. If an insurance policy written in 2023 was based on a projected legal cost of $50,000, but by 2026 that same legal work costs $75,000, the carrier is facing a $25,000 deficit per claim that was never priced into the original premium. This is why the statistical review of market readiness must include a legal inflation buffer. The companies that are built of steel are those that have adjusted their premiums dynamically to match the rising cost of the New England legal market. Imagine if you were a policyholder and you discovered that your carrier's claims-paying ability rating had been downgraded from an A to a B+. In the insurance world, this is a signal that the company's capital cushion is thinning. In late 2026, we are seeing the emergence of matrimonial risk retention groups. These are smaller member-owned entities where groups of professionals, such as doctors or engineers, pool their own money to provide their own divorce insurance. This is a response to the perceived instability of the larger commercial carriers. These groups operate with much lower overhead and no need for global reinsurance, but they lack the massive scale of the Hartford giants. It is a trade-off between local control and global backing. Step by step, an investor or a policyholder can evaluate a carrier's strength by looking at 3 key metrics. Metric 1 is the combined ratio. If this number is over 100, the company is losing money on its underwriting and relying entirely on investment income to stay afloat. In 2026, Several New England carriers are hovering around 98, which is a razor-thin margin. Metric 2 is the risk-based capital ratio, which measures how much capital a company holds relative to the risks it has taken on. In Massachusetts, regulators require a minimum of 200%, but the steel companies are currently sitting at 400% or higher. Metric 3 is the reinsurance recoverable balance. This shows how much money the company is owed by its global partners. If this number is too high, it suggests the company might be over-leveraged and vulnerable if a global reinsurer contests a claim. The data reveals that the New England market is currently in a bifurcation phase. There are the legacy carriers in Hartford who have the scale and the global backing to survive a major economic shock. And there are the newer tech-driven insurtech startups in Boston that offer lower premiums but have much thinner capital cushions. For the New England public in 2026, the choice is between the perceived safety of a 100-year-old brand and the efficiency of a digital-first platform. Historical trends in the broader insurance industry suggest that during the first major crisis, the smaller, undercapitalized players will be swallowed up by the giants, leading to a more consolidated and perhaps more expensive market. But there is a final, hidden factor in the solvency equation: the role of the state government. In New England, state insurance departments have the power to take over a failing carrier to protect policyholders. This is the ultimate safety net. If a major divorce insurer in Connecticut were to go insolvent, the state's guarantee fund would step in to pay the remaining claims, funded by assessments on all other insurers in the state. This means that even if a specific company is made of spiderwebs, the system itself is reinforced with a state-mandated safety net. However, this protection has limits, and it can take years for claims to be processed through a state-run liquidation. As we conclude this part of the masterclass, we have to recognize that the financial engineering behind divorce insurance is becoming as complex as the marriages it protects. We have seen the reserves, the reinsurance treaties, and the regulatory hurdles. But as we look toward the final stages of this review, we must address the most significant unknown of all. If the money is there, and the legal system is ready, what does the actual data say about the long-term impact on the New England economy? Is divorce insurance creating a more stable middle class? Or is it simply a transfer of wealth from the public to the insurance and legal industries? And most importantly, as we move into Part 9, we are going to look at the actuarial endgame. We will examine the secret data sets that insurance companies are using to predict who will get divorced before the couples even know it themselves. We are about to look at the future of predictive matrimony and the ethical firestorm it is creating in 2026. In 2026, the concept of privacy in the New England corridor has been fundamentally redefined by the actuarial desire for total precision. We are no longer living in an era where insurance companies simply look at your age, your zip code, or your occupation to determine your risk level. Instead, we have entered the age of predictive matrimony, where the massive data sets flowing out of tech hubs like Boston and Cambridge are being weaponized to predict the end of a marriage before the couple has even had their first serious argument about the mortgage. This is the new frontier of risk management, and it is creating an ethical firestorm that is currently being debated in the state houses of Montpelier and Augusta. To understand the market readiness for divorce insurance, we have to understand the algorithm that sits behind the curtain, watching every transaction, every social media interaction, and every late-night GPS ping. Consider the step-by-step process of how an insurance carrier in Hartford compiles what is known as a matrimonial stability score. Step 1 is data ingestion. In 2026, data brokers sell granular access to credit card spending habits. Actuaries have identified a historical trend known as lifestyle drift. This occurs when a couple's spending habits, which were once highly synchronized, begin to diverge into individual silos. For instance, if a husband in Worcester, Massachusetts, begins spending significantly more at solo dining establishments or boutique clothing stores, while his wife simultaneously increases her spending on individual travel or separate social outings, the algorithm flags this as a disengagement pattern. Step 2 is sentiment analysis. Using specialized AI, carriers can monitor the public-facing social media metadata of policyholders. They aren't just looking at the photos, they are looking at the frequency of mutual tags, the speed of responses to each other's posts, and even the complexity of the language used in captions. A decline in these metrics is statistically correlated with a higher probability of filing for divorce within the next 24 months. Imagine a couple named Ethan and Maya living in Burlington, Vermont, in the spring of 2026. Ethan is a high-level data analyst for a green energy firm, and Maya is a prominent restoration architect. They have carried a divorce insurance policy for 5 years, and it is fully vested. Suddenly, upon their annual renewal, they receive a notification that their monthly premium is increasing by 30%. When Ethan calls the carrier to inquire why, he is met with a vague explanation about updated risk models. What he doesn't realize is that the carrier's algorithm flagged 3 distinct lifestyle changes. Maya recently joined a high-end gym and updated her professional headshots. Ethan started working late 3 nights a week at a co-working space instead of his home office, and their joint grocery spending dropped by 40% in favor of individual meal delivery services. To the computer in Hartford, Ethan and Maya are no longer a stable unit. They are a high-probability claim waiting to happen. This leads us to the potential outcomes of what scholars at Harvard Law are calling matrimonial redlining. If an algorithm decides you are likely to get divorced based on your spending or your digital footprint, the insurance company cannot legally cancel a vested policy, but they can make the cost of maintaining that policy so high that the policyholder is forced to drop it. This creates a scenario where the most vulnerable couples, those currently experiencing the highest levels of stress, are the ones who lose their safety net right when they might need it most. In response, Massachusetts has introduced the 2026 Algorithmic Transparency Act. This legislation requires insurance companies to disclose the specific data points used to justify a premium hike. However, the insurance lobby argues that disclosing these algorithms would reveal trade secrets and allow people to game the system by intentionally faking a happy marriage on paper. The ethical firestorm extends to the concept of the privacy tax. In 2026, some New England carriers are offering a discount to policyholders who agree to wear a continuous health monitor or provide full access to their private messaging metadata. The potential outcome is a 2-tiered system. A premium tier for those who are willing to live under total surveillance to prove their marital stability, and a much more expensive tier for those who insist on their right to privacy. Historical trends in the health insurance industry suggest that once these tracking programs are introduced, they eventually become the mandatory baseline. For a couple in a place like Newport, Rhode Island, where social standing is tied to discretion, the choice between financial protection and personal privacy is becoming a zero-sum game. Let us look deeper into a case study from a small town in Maine, where a local teacher and a fisherman were denied a policy altogether. The reason cited by the insurer was a geographic risk factor. In 2026, actuaries have mapped out social contagion zones where divorce rates are statistically higher due to local economic shifts, or even high rates of addiction within a community. This is a form of predictive bias that penalizes individuals not for their own behavior, but for the behavior of their neighbors. The data shows that if you live in a zip code where the divorce rate has increased by more than 5% in a single year, your individual risk score is automatically downgraded. This creates a cycle where the very communities that need financial stability the most are priced out of the products that provide it. Step by step, we are seeing the rise of the preemptive divorce intervention. In a radical move in early 2026, one Boston-based insurer started sending out automated gift certificates for marriage counseling to couples whose data patterns suggested an imminent breakdown. While this might seem helpful, it felt like a chilling intrusion to the recipients, many of whom didn't even realize their relationship was being scrutinized by a machine. Imagine if your insurance company knew your marriage was failing before you did. This is the psychological weight of the 2026 market. It turns the insurance carrier from a silent partner into an active, and often unwelcome, observer of the most intimate parts of human life. The intellectual hub of New England is currently the primary battleground for these ideas. MIT researchers are developing counter-algorithms designed to help couples mask their data and maintain their privacy scores, while the insurance industry is hiring the same researchers to close those loopholes. This is a digital arms race. The market is ready for the product, but the social fabric is struggling to keep up with the implications. We are quantifying the unquantifiable, and in doing so, we are changing the nature of the relationship itself. When you know that every move you make is being evaluated for its matrimonial stability, you start to act differently. You might stay in a toxic situation just to keep your insurance score high, or you might trigger a divorce earlier than intended just to capture a payout before your premium becomes unaffordable. As we look at the statistical review of 2026, one thing is certain. The data doesn't lie, but it also doesn't see the whole truth. It can see the spending, the GPS pings, and the social media tags, but it cannot see the resilience of the human heart or the capacity for forgiveness. The New England market is the testing ground for a future where every human emotion is a data point, and every commitment is a risk to be hedged. We have examined the algorithms, the ethical debates, and the rise of the surveillance marriage. But there is one final piece to this masterclass. As we move into our conclusion, we are going to look at the global implications of the New England experiment. How is the rest of the world reacting to the financialization of the American family? And what is the ultimate endgame for a society that has decided to ensure its own heartbeat? The final part of this journey will reveal the global impact and the unexpected legacy of the divorce insurance revolution. The global financial community is currently fixated on the New England experiment as the ultimate proof of concept for the commodification of domestic stability. As we conclude this statistical review in late 2026, we must recognize that what began as a niche insurance product in Hartford has evolved into a global financial derivative that is fundamentally altering the London-Hartford corridor. Reinsurance giants in Zurich and London are no longer just passive observers. They are actively recalibrating their global matrimonial risk models based on the high-density data coming out of Massachusetts and Connecticut. This is the birth of a new asset class. For the first time in history, the statistical probability of a marriage's success is being traded, hedged, and leveraged on the global stage, creating a ripple effect that extends far beyond the suburban streets of New England. To understand the global impact, we have to look at the historical trends of financial innovation. Just as the credit default swap changed the nature of corporate debt in the early 2000s, divorce insurance is changing the nature of the marital contract in 2026. Imagine a financial analyst in Singapore named Kenji. Kenji is looking at the potential outcomes of launching a similar product in the Asian markets. He is studying the New England data step by step to understand the adverse selection thresholds. He sees that in a region with high education and high asset transparency, the product is not only viable but highly profitable for the carrier. Step 1 of his analysis is the cultural translation of risk. In Tokyo or Singapore, the social stigma of divorce remains higher than in Boston, but the financial risk is equally catastrophic. Kenji is betting that the New England model of economic pragmatism will eventually override cultural taboos. This global expansion is the first major legacy of the New England Revolution. But the most unexpected legacy within the United States is the emergence of the Matrimonial Stability Index, or MSI. By mid-2026, the MSI has become a secondary economic indicator that Wall Street analysts use to predict consumer spending patterns. Because divorce is one of the primary drivers of household deleveraging and liquidation, the MSI provides a forward-looking view of market volatility. If the MSI shows a spike in pre-claim activity in the Northeast, retailers and real estate developers prepare for a contraction. Conversely, a stable MSI suggests a period of robust, joint household accumulation. This is the total financialization of the American family. We are no longer just looking at the Consumer Confidence Index. We are looking at the Commitment Confidence Index. Let us look at a final case study involving a character named Ava, a senior regulator with the Massachusetts Division of Insurance. In October 2026, Ava is reviewing the 3-year performance data for the top 5 carriers in the region. She discovers a startling unintended benefit. Historical trends indicate that in counties with the highest per capita adoption of divorce insurance, the average time to settle a divorce has dropped by nearly 40%. Why? Because the insurance-mandated mediation clauses are working. When a policyholder is required to engage in a collaborative process to unlock their payout, the scorched earth litigation that previously clogged the New England court system begins to evaporate. The potential outcome is a more efficient judicial system, saving taxpayers millions in administrative costs. Ava realizes that the insurance companies have achieved what the state legislature could not. They have incentivized civility through the bottom line. However, we must also address the wealth gap legacy. As we move toward 2027, the data reveals a stark divergence. For the affluent professional class in New England, divorce insurance has created a buffer zone that preserves intergenerational wealth. They are using these policies to ensure that family estates remain intact, even when marriages do not. But for the working class in regions like northern Maine or western Massachusetts, the premiums remain out of reach. This creates a two-tiered legal reality. One group has the liquid capital to navigate a separation with dignity and professional counsel, while the other remains vulnerable to the predatory litigation spiral we discussed in Part 1. The 2026 Statistical Review suggests that without state intervention or a socialized risk pool, divorce insurance could become the latest tool for widening the American wealth gap. Step by step, We are also seeing the integration of these policies into the employee benefits packages of top-tier firms. Imagine a young attorney starting at a prestigious Boston firm in late 2026. Along with health insurance and a 401k match, they are offered a domestic stability supplement. The firm pays half the premium for a divorce insurance policy, as a way to ensure their high-value associates aren't distracted by financial ruin if their personal life takes a hit. This is the ultimate corporate endgame. The firm is essentially insuring its own human capital. Historical trends in key person insurance are being applied to the home life of every employee. It is a world where the company has a vested interest in the mathematical health of your marriage. The final data point in our masterclass is the longevity paradox. In a surprising turn, some 2026 studies are suggesting that couples with divorce insurance actually report higher levels of marital satisfaction. Psychologists believe this is due to the elimination of the trap. When both partners know they have a dignified financial exit, they feel less coerced into staying, which paradoxically reduces the resentment that leads to divorce in the first place. The insurance acts as a pressure release valve. While critics feared it would encourage divorce, the potential outcome for a segment of the population is actually a more voluntary, and therefore more stable union. This is the most controversial finding of the 2026 review, and it is currently being challenged by traditionalist groups across the country. As we look at the big picture, the New England market has proven that matrimonial risk is not a chaotic, unpredictable force of nature. It is a quantifiable, manageable, and insurable variable. We have seen the algorithms that predict it, the trusts that shield it, and the global markets that bet on it. We have moved from the taboo of the end to the utility of the exit. The American dream in 2026 is no longer just about the white picket fence. It is about the insurance policy that ensures you don't lose the fence in the settlement. But this is only the beginning of the story. While we have mastered the what and the how of divorce insurance, a new and even more complex financial frontier is emerging on the horizon. As we look toward 2027, the same actuaries who built the divorce insurance models are turning their attention to an even more volatile aspect of the human experience. They are beginning to model the cost of loneliness and the risk of aging alone in a post-nuclear family society. The infrastructure built for divorce insurance is about to be repurposed for something even more ambitious. If you thought the financialization of marriage was intense, wait until you see how the market plans to ensure your social circle and your support system in the decade to come. The New England experiment was just the pilot program for the total life risk era. In our next series, we will dive into the actuarial review of the loneliness epidemic and how 2027 will see the rise of community continuity bonds. The question remains, in a world where every relationship is a risk, what is the cost of staying human? We will see you in the next deep dive.